Thank you, Mr. Chairman, and good morning, everyone. When I'm putting these presentations together, I am a little bit awkward. I do like to try new things, and this year is no different, as today I'm actually going to start with a conclusion, which is last year's conclusion, to be precise. As a year ago, we stood over the road, and we were really discussing the impact of South American soybeans on the global oilseed market, looking at the discounts from palm oil to other oils in the world and the impact of weather that was having on global supply. And then closer to home, we were looking at the tight European rapeseed market and the need to switch crush. Now, this year, the messages are relatively similar, as the analysis for the conference this year is again looking at the global supply and demand imbalance in oilseeds, specifically looking at how South American soybeans can have a longer-term influence on the volatility of markets, and again, the need to switch demand driven by price discounts, and again, the palm oil and soy oil there. And again, for the EU, it's a continuation of a theme that we've seen really for the past 2 or 3 years, where there's been a lack of supply driven by poor weather and continued strong demand, creating this tight fundamental market. So the need to switch crush has continued and will continue for the rest of this season. So this begs a question, which is the lack of supply response, whether that's being driven by detrimental weather or by the increased competition from grains, having a direct impact upon the volatility in markets, as it is creating a situation where demand will more regularly be outstripping a supply which is less responsive, and therefore what we're seeing at the moment in the current volatile conditions are now actually the norm for markets and will continue to be the norm for markets for the foreseeable future. When we're comparing volatility, if we look historically, markets are very volatile compared to what they were 10, 15 years ago, but this is a very different world in terms of the global supply and demand to where we were over that period. And the global supply and demand for oilseeds is a really good place to start and frame the whole presentation and analysis today, as what we've seen for the 2011-12 season, highlighted just here in the red ring, is that we're moving into a deficit in global oilseeds this year. This is predominantly driven by a deficit in soybean markets, as I'll talk about in a moment's time, but it's also driven by the consistent strong demand, and this consistent strong demand has been despite the global lack of economic prosperity that we've seen in the past couple of years. So you've seen a supply which has been less responsive and a very strong demand, and therefore that's reducing the level of oilseed stocks in the world. And that's the real sort of overall key theme for the 2011-12 global oilseed market, that we are moving into a period of lower stocks, moving into a deficit, and that has been creating this relatively firm sentiment towards oilseed prices around the world. But the demand, as we've seen, has been driven by East Asia, and this Asian demand is for both human consumption, vegetable oil, and also for protein meal going into animal feed. The graph on the left is showing the Indian vegetable oil consumption over the past 5 years, and how the blue line there has been increasing in per capita terms, whilst the GDP growth has actually been decreasing. So we're seeing consistent increases in demand in Indian veg oil, whilst there has been less growth in economic prosperity in that country. On the right-hand side, we're looking at Chinese soybean consumption in imports terms, and also the pork consumption, and this again is being seen steady increases as we've moved over the past couple of decades. And this is why I was saying that when we're comparing the volatility, if we're comparing to recent years, it's not particularly volatile what we're seeing at the moment, but compared to 10 years ago, it is extremely volatile. So for the short term, the norm will be a continued period of volatility in both the global oilseed market, and that will help to spill over into the grain market as well. But as I was saying earlier, the main reason for the reduction in the supply and the deficit that we're seeing in global oilseeds this year has been because of the soybean market. We are expecting that the global soybean market will move into a deficit, as is highlighted by the blue line there, the blue column rather, which is around about a 5 million tonne deficit for global soybeans. This is predominantly driven this year by lower US production, which was again due to the less than favourable growing conditions at both planting time and then through the growing season and the key yield forming period. So for the global soybean market overall, we're seeing a deficit and therefore a reduction in stocks from around 68 to 61 million tonnes. This is ending stocks of soybeans for the 2011-12 season. And again, in general terms, as a whole season point of view, this does provide quite a firm outlook for prices given the deficit and the lower stocks. But this is actually hiding the structural supply and demand in both the short term and the long term within the 11-12 marketing year, which we'll have a look at now. So for the first quarter of the 11-12 season for soybeans, what we're seeing is despite the lower production in the US, there are larger stocks which are being held in South America. As we've seen over the past couple of years, there's been a strong incentive to plant and grow soybeans driven by the higher prices that we've seen. And this has helped to replenish stock levels from a very low period that we saw in the 2008-9 season, where they saw a very weather-affected season in South America, notably Argentina. So South American soybean stocks are forecast at a record being carried into this season. We are still seeing that US harvest pressure coming on the short term, and this is meeting a period of relatively sluggish growth in soybean demand around the world. What we've seen from China, the graph on the right shows, is that despite us having an increase in soybean import demand in the 11-12 season, it is 1.5 million tonnes less than what we were expecting at the start of the season when the first estimates were made in May. And also added to this, through the summer months, what we've seen is there's been less than favourable crush margins for China, and therefore they've been reducing their domestic stock levels as well. So for the short term, the demand is relatively sluggish, while the stock picture in South America and the overall global supply of soybeans in the short term is relatively favourable. So for the first quarter of the season, it seems as if the supply and demand balance for soybeans is relatively comfortable and definitely differing from the longer term picture. As we move into the second and third quarter, so from January through to the June of 2012, this is the point where the soybean market changes its short and long-term outlook. As through the January through April period, we will again be getting a large amount of production coming from South America, forecast currently at a record of just over 137.5 million tonnes. And again, this will add more supply pressure coming into the new year. But this also can then impact on the longer term of the 2011-12 marketing year and also into the 2012-13 marketing year through the potential impacts that it has on the incentive for US farmers to plant soybeans. The graph on the right-hand side is showing the price relationship of new crop 2012 soybean and maize prices in the US. And what we've seen throughout 2011 is the price relationship has been favouring maize much more. So if we get a large amount of South American soybeans coming online through January and April, and the US farmers are then moving to make their planting decisions, you could see the harvest pressure from the South American soybeans dragging the soybean complex lower to a point where it is still remaining uncompetitive with the US values. What we're seeing at the moment is that for the maize prices where they currently are at around $5.80 per bushel, that would mean that you would need a soybean price of over $13 to move into that neutral range that we see there of around 2.3 in the ratio. So therefore, soybean prices to reach a neutral point for new crop 2012 in the US need to be gaining by about $1.10, $1.20 just to remain on a level playing field with maize in the US. And again, this is why I was saying from that question that I posed earlier that you're seeing a greater competition for area in the US, most notably, which is again creating this longer term volatility in soybeans, as the US, as Jack was saying, is the dominant feed grain producer. So if you have a problem in the US, you have no other real alternative to switch to. However, for soybeans in the US, if there is a problem, you always have the South American crop becoming online a few months later. So there's always a backup to supply. So for that reason, it's less important in terms of the global perspective, even though, as we see from the graph here on the left-hand side for US ending stocks, for soybeans in the fourth quarter, they'll only be covering about 19 days of demand, which is relatively similar to the level of maize stock coverage as well that we see in the US. So both the stock level of coverage of demand is relatively similar for maize and soybeans, but more emphasis is being placed upon the maize rather than soybeans because of its importance in global terms. So for the second and third quarter, you're looking at a period of changing from shorter term large supplies to the longer term impacts of low stocks in the US as we see here, and a lower global stocks to use ratio for the 2011-12 season as well. So in summary, for the global soybean market, what we're seeing is we're seeing the first deficit since 2008-9. However, for the short-term, supplies are relatively comfortable being met with this slower than expected increase in demand. But we see this longer-term problem, which is still occurring in the soybean market globally, that the stocks, most notably in the US, are not being replenished because you're seeing a greater level of competition from the maize market especially. So the prices are stuck in a short and long-term perspective. What we've seen over recent weeks with the uncertainty in global economics is that prices have been dragged lower, but this is, again, in the context of the longer term, slightly moving away from what the fundamental picture is showing, as we know there is those low stocks in the US. But also the global oilseed complex, as well as being influenced by the soybean markets, will also be influenced by the relationship of palm oil to the rest of the oils and the subsequent demand switching that we see. So for palm oil, looking at Malaysian monthly production over recent years, we do see a large decline or seasonal lull in production from the November through February period each year, as highlighted by the red lines or the red pieces of the line on this graph. And we're now moving into this slower than expected or slower than historical production level on a monthly basis from East Asia. And this is being met by a current large price discounts, because as we can see through the 2011 period on this graph, monthly production has been increasing as you've seen beneficial weather and also a maturity in the plantations, so they've reached their optimum period for producing palm oil. And this has had the effect of increasing the price discounts from soy oil to palm oil to well over $200 per tonne recently. The palm oil price and the discount has been increased over the past week or two as the palm oil prices have been driven lower, again, by the global economic uncertainty. But again, this is showing that the vegetable oil market is working rationally, as it's seeing a market which has relative tight supply and demand insofar as the soybeans, and currently what is a larger amount of supply from the palm oil, and is attempting to move the demand from one area to the other. So again, for the short term, it's a relatively comfortable picture for palm oil, as we've had very large amounts of production through 2011 so far. And this has had the effect of increasing the stock levels, as we see through the pale bars here, through 2011. So stocks are currently very large. And also exports have been increasing this year as well. And this is again driven by the large price discounts. But this does indicate a problem as we move through the winter months, as we are seeing strong demand given the large price discounts, but we are now moving into this seasonal lull in production. And this could be another area of volatility for the global oilseed market and the veg oil market as we move through the first period of 2012 and we see the impact of this lower palm oil production. Because in essence, in my opinion, then there's only really two options for the palm oil market in response to the seasonal lull in production and the steady demand that we're seeing from the large price discounts. This will either be that stocks will need to be reduced to keep the export level relatively similar to what it is now, given the large price discounts, even taking into account the lower production, or the prices would need to move to a relationship where they are less favourable to palm oil to slow the level of demand as we move into this period of lower seasonal production. Obviously, both of these aspects are implying either lower stocks or a tighter relationship in the supply of soy oil and palm oil. And both of these is, again, relatively a firmer picture for prices in the long term. So the outlook for palm oil could very well be that it's throughout the 2012 annual calendar year could be adding a supportive base to the veg oil market as the demand is relatively strong, and yet we're moving into a period where we see lower than anticipated production than what we have seasonally. Also, what we see is after years of relatively abundant production in palm oil, as we've seen this year due to the maturity of crops, the plantations then need to have a period of recovery. So therefore, there's still some uncertainty over whether the production capabilities from East Asia can match what we've seen this year if the maturity of the palm oil plantations are not as large as what we've seen currently. So for the longer term, again, there remains that uncertainty as to where will the supplies of palm oil come from and where will the price relationships eventually end up. But again, it does add to a longer term firm sentiment towards prices. So the global outlook obviously has these two very differing short and long-term influences. And it's very difficult for an analyst such as myself to really be finding a definitive direction upon which way oilseed markets are going to be moving throughout this period. And so for the European market, following on from these, it's very difficult to judge how the European market will fit in. But one thing that we do know is that given the tight supply of rapeseed that we've seen for the past 2 years, there is still a large deficit in European rapeseed. This year, the production is expected in the EU of around 18.7 million tonnes. This may be between 18.5 to 19 million tonnes, really dependent on what the final yields from Germany really are. And with the demand staying at 21.3 million tonnes, given strong demand driven by the biodiesel mandates, this is giving a 2.6 million tonne production to demand deficit in Europe. So we will need to be importing between 2.5 and 3 million tonnes of rapeseed. Now, the majority of this is likely to be coming from Canada, the Ukraine and Australia. And currently the crop estimates for these three regions are a lot better than what we're seeing for Europe. So there are the import availabilities that Europe needs. But from the point of view of the longer term price definition, what we've seen in Europe is that there's been a split between the west of Europe in terms of the weather that we saw over the past year and the east and central of Europe. And really what we saw was for the area highlighted here in that sort of eastern Germany, western Poland border, they've had considerably poorer weather than the rest of Europe in terms of rapeseed planting and growing seasons for the past 2 years. This is really the key area for the European rapeseed market for what will happen for the price direction of the 2012 crop. Because the weather from Berlin in East Germany to Poznan in West Poland will be as influential, if not more influential, upon the European prices and UK prices to what the weather is doing in Cambridgeshire and Lincolnshire over the next year. This is going to be the key driver. This is where we've seen the largest deficit in rapeseed supply for the past 2 years, and this is therefore where the largest supply potential remains for 2012 if there's beneficial weather. So again, for the longer term, even though we're seeing a relatively continuing sentiment in European rapeseed remaining relatively firm, for the longer term, the picture remains uncertain because there remains this deficit in the low stocks and the need for an increase in rapeseed production, which will be driven by this Central European area. But one point of view from the rapeseed markets and the European oilseed market is that we have seen a larger sunflower seed production this year in both Europe and Russia and the Ukraine. So the first graph here is showing the production changes from 2010 to 11 for oilseed rape and sunseed. We can see that oilseed rape has obviously seen a reduction in output, whereas the sunseed production is higher. And this has led to prices moving in a rational manner and rapeseed moving to a larger premium over sunseeds, given the relative changes in supply that we've seen. But at the same time, vegetable oil prices for the two have remained relatively similar, and this has led to crush margins for sunflower seed increasing greatly, whereas the rapeseed crush margins have stayed relatively static. So this is showing the continued need for demand, mainly for food oil production in Europe, and to a lesser extent for biodiesel production, the demand for crush to move from rapeseed towards sunseed, given the relative changes in the supply and demand that we've seen for the two markets. So this is both showing potential for a continuation in the same price relationship that we see now, but also it shows that the European oilseed market is working in a healthy and rational manner. There is no outside influences which are affecting the favourability of one crop to crush rather than the other. It is purely being driven by the supply and demand. So for conclusions on Europe, we're seeing continued tight oilseed rape supply and demand, and this is likely to keep rapeseed oil prices firm relative to the rest of the global oilseed complex. And again, that need to continue to switch crush is going to be key. But what we've seen over the past 2 to 3 years is this tight mainland European fundamentals have been supporting the UK crop, and this has been supporting the UK prices in terms of giving the economic incentive to plant more rapeseed. So for the UK, what we've seen this year is that the yield achieved was about 3.9 tonnes per hectare, as reported by DEFRA this morning, which gives us a production of over 2.7 million tonnes, which is a record. We've seen a record area production and yield for rapeseed this year in the UK. But again, the incentive to plant that was entirely driven by European mainland fundamentals lacking the supply. So from a UK perspective, we're seeing a very large potential exportable surplus this year, and this is likely to be achieved maybe 500,000 tonnes or above, considering the lack of supply that we see mainly in Germany. So there is a very large export market for the UK. But again, the UK prices will still follow that European trend as we move forwards. But looking for 2012, as Jack was saying earlier, there remains that continuing economic incentive to be planting oilseed rape for next year. And it seems as if the prices stay as they are, the oilseed rape area will again remain large in the UK in 2012. But recent research undertaken by HGCA, NIAB and TAG has shown that when you tighten rotations of oilseed rape in the UK, you do see the potential for greater yield impact and yield losses driven by lack of vigour and an increase in disease impact as well. So the yield risk for oilseed rape is extremely uncertain, given this year we've seen a record, but the research is pointing to a period where tightening rotations will actually decrease yield potential of rapeseed crops. Therefore, in my opinion, the marketing and the selling decisions by farmers for oilseed rape this year is going to be much, much tougher than what we've seen over previous years, because you have the cumulative effects of uncertain yield potential for 2012, you have the European prices being driven by the European mainland fundamentals, nothing to do with the UK. And then you also have this uncertain short and long-term global oilseed perspective as well. So it's currently very difficult to put a longer-term perspective on the direction of oilseed rape prices. The only real firm thing that we can say is that they are, relative to the rest of the global oilseed complex and global veg oil complex, going to stay relatively firm given the tight supply and demand that we see relative to the other oilseeds. So if the marketing is much more difficult, where do we look out for? What are the market drivers going to be for the 11-12 season and beyond? Really, it's the uncertain fundamentals of soybeans in the longer term. This will be the key driver. Looking forwards to what's happening in the summer of 2012 and beyond will be the key thing, as global stocks are expected to reduce. US stocks are still theoretically extremely tight, if not theoretically impossible, given that the period of time that it would need to move through the pipeline. And therefore there still needs to be a supply response from soybeans in the 2012 marketing year in the US. But again, as I was saying earlier, this could be harmed by the increase in South American production and the increased competition that we see from grain crops as well. Global veg oil demand is continuing to stay strong and continuing to increase, and this is despite the lower, or the less optimistic, should I say, global economic perspective, and this looks likely to continue. So you're going to see a continuation in the sentiment and the picture of global oilseed markets for the rest of the 2011-12 marketing season and into 12-13, because you're seeing this steady demand and this uncertain supply driven by erratic weather and the competition from grain crops. And from a European point of view, understanding where European prices are going to move to over the next year, and the potential to move back to either a smaller deficit or even a surplus, the European weather in that Central European, East Germany, West Poland region will again be key for both the European and UK price direction over the next year. So that's a short, quick overview of the main drivers that we expect for 2011-12, 12-13 and beyond. If you have any questions, I'd be more than happy to take some now.